Everything looked bullish here, until one reaction candle completely changed the market. And the scary part is, the crash was already predictable before price even started dumping. The supply zone was there, the inducement was there, the SSL target was there, and after the first sell-off, price came back into a precise bearish order block before collapsing again. In this video, I'll show you how the market engineered this entire move step by step. Now, this area right here is the supply zone, and this is where the entire market started changing. The moment price entered this zone, bullish momentum immediately became weak. No strong continuation, no acceptance above highs, only rejection. And that tells us something very important. Smart money was no longer interested in pushing price higher from premium pricing. At first, this market looked extremely bullish. Price was respecting highs, building confidence and trapping breakout buyers above inducement. But then, price entered this supply zone, and everything changed. One aggressive rejection shifted the entire order flow bearish. And the most dangerous part? After the first dump, price came back into a clean bearish order block, respected it perfectly, and delivered another collapse straight into SSL. In this video, I'll break down how smart money engineered this entire move before the crash even happened. And this is where most traders got completely misled. Because while everyone was expecting price to break higher, the market was actually building liquidity for a bearish reversal. And the dangerous part? The entire collapse was already forming inside the structure before the move even started. Now here, we had inducement. Price kept respecting these highs repeatedly, creating the illusion of bullish continuation. This attracts breakout buyers and builds liquidity above the market. But smart money doesn't see breakout opportunities here. They see fuel. And that liquidity becomes the perfect setup for a reversal from premium pricing. And now, below the market, we had sell-side liquidity. This area becomes extremely important because that's where stop losses and weak long positions are resting. So once the market starts turning bearish from supply, sell-side liquidity immediately becomes the target, because smart money needs liquidity below the lows to continue the move efficiently. And this is why the market started getting pulled lower, step by step, toward these lows. So now think about the full picture here. Liquidity was already built above the market through inducement, and liquidity was also resting below the lows as sell-side liquidity. That means the market had fuel for entry and a clear target for expansion. At this point, the setup was no longer random. The market was preparing for a major liquidity-driven move. The moment price touched this supply zone and delivered strong bearish displacement, we entered the sell trade, targeting the liquidity resting below the lows. And look at the reaction carefully. Price rejected aggressively from premium pricing. Bullish continuation completely weakened, and the market instantly started accepting lower prices. That tells us institutional sellers had entered the market with strong control, and once bearish momentum expanded, price started driving directly toward sell-side liquidity. But after the first sell-off, the market gave one more opportunity. Price came back into this bearish order block right here and started reacting again. Many traders expected a reversal from this area. But the moment price respected the order block and failed to continue bullish, we entered the second sell trade, targeting the liquidity below the lows once again. So this entire move was engineered step by step. Liquidity was created above the market. Supply was respected perfectly. Bearish displacement confirmed the reversal, and price finally attacked the liquidity resting below the lows. This is how smart money moves the market. And once you start understanding liquidity and order flow like this, the market stops looking random.